Here's something that doesn't get talked about enough. The characteristics that make someone good at their job, such as analytical thinking, pattern recognition, the ability to synthesize complex information quickly, and high standards for evidence before acting, are almost perfectly designed to make them a worse investor, not a better one. Worse. That's not an opinion. That's what the research consistently shows. And if you are someone who considers yourself reasonably intelligent, informed, and capable of thinking through complex problems, this video is probably about you. Let me be clear about something before we go any further. This is not about intelligence being bad. Intelligence is obviously useful. The problem is more specific than that. It's about what intelligence does inside a financial market environment, an environment it wasn't designed for, and the very particular ways that high cognitive ability becomes a liability when it's applied to a system that actively punishes certain kinds of smart thinking. The market doesn't grade on effort or rigor. It doesn't reward the quality of your analysis. It rewards outcomes. And those two things, quality of analysis and quality of outcomes, are far less correlated in financial markets than smart people tend to assume. The first and most significant mechanism here is something called the illusion of explanatory depth. This is the documented psychological tendency to believe you understand something more deeply than you actually do. And it's amplified by intelligence because smart people are very good at constructing explanations. Here's how it plays out in investing. You read about a company. You understand its business model. You follow the industry. You see the macro trends. You build a mental model of why this investment makes sense. And your brain, your capable, pattern-finding, explanation-generating brain, produces a story that feels coherent, rigorous, and well-reasoned. The problem is that the felt coherence of your explanation has almost no relationship to its predictive accuracy. A story that feels complete and logical is not the same as a story that correctly describes a complex adaptive system like a financial market. Markets are not puzzles to be solved. They are systems shaped by the collective behavior of millions of participants, each of whom also believes they have an edge, also believes they've spotted the pattern, also believes their model is more sophisticated than the average. The market price of any asset at any given moment is the aggregated output of every one of those participants acting on their best available information, which means that your analysis, however rigorous, however thorough, however intelligently constructed, is almost entirely priced in before you act on it. The edge you think you've found is usually the edge everyone else already found. And the more confident your analysis makes you feel, the more dangerous that confidence becomes. Now, here's the thing that makes this especially painful for smart people. They don't just form these explanations, they commit to them. There's a well-documented cognitive pattern called belief perseverance, the tendency to maintain a belief even after the evidence that originally supported it has been discredited. And it's stronger in people with higher cognitive ability. Why? Because smart people are better at generating counterarguments to evidence that challenges their existing view. They don't abandon the thesis, they defend it. They find the flaw in the contradictory data. They reinterpret the negative signal as a short-term anomaly. They hold on longer, and they lose more. Think about what this looks like in real life. A position starts moving against you. Someone who built a modest thesis and a modest emotional attachment cuts the loss and moves on. Someone who spent 2 weeks researching the fundamentals, who built a detailed model, who is genuinely convinced their analysis is correct, that person holds. They read more articles supporting their view. They discount the articles that don't. They wait for the market to catch up to what they know. Sometimes it does. Often it doesn't. And the intellectual investment they made in being right becomes as expensive as the financial one. This connects to something called the Dunning-Kruger effect, though not in the direction most people apply it. The commonly understood version is that low-knowledge people overestimate their ability. But the research has a less cited second finding. High-knowledge people in a domain tend to also overestimate their edge in adjacent domains. A doctor who has spent 30 years mastering diagnostic medicine feels fluent in complex systems and transfers that fluency confidence to financial markets, where the epistemics are completely different. A lawyer who is genuinely excellent at finding patterns in evidence feels similarly capable of finding patterns in stock charts. The skill is real. The transfer is not. And the more genuinely accomplished you are in your actual field, the more invisible this transfer problem tends to be. And then there's what I think is the most underappreciated mechanism of all. It's called active management bias, the belief, amplified by intelligence, that doing something is always better than doing nothing. Smart people are uncomfortable with passivity. Their entire professional and intellectual identity is built around adding value through analysis, judgment, and action. Sitting in an index fund and literally doing nothing feels like a dereliction. It feels like leaving money on the table. It feels like not using the capacities they've spent decades developing. The inactivity itself feels wrong, not because it's producing bad outcomes, but because it doesn't feel like enough. And the market is exquisitely good at providing stimulation for exactly this tendency. There are always new data points to analyze, always new positions to take, always a thesis to build and defend. The financial media ecosystem exists specifically to generate this stimulation, because engagement requires the continuous production of material that rewards analytical thinking while providing almost no actual edge. The smart investor reads more, analyses more, trades more, and performs worse. Not because they made a mistake, because the activity itself was the mistake. Here's the counterintuitive truth that the research has been pointing toward for decades. The best investment strategy for most people is also the most boring one. Broad market index funds, consistent contributions, minimal intervention, long time horizon. That strategy has outperformed the majority of actively managed funds over almost every meaningful time period. Not because the people running those funds are unintelligent. Many of them are extraordinarily smart. But because the market is an efficient enough system that consistent outperformance through active analysis is extraordinarily difficult to sustain, and the costs of trying, in fees, taxes, and trading friction, compound against you over time. The investors who do best at the individual level are not the ones with the most sophisticated models. They're the ones who have accepted the limits of their edge and built a system they don't need to constantly intervene in. There's a famous fidelity study, often cited, disputed in its specifics, but pointing at something real, suggesting that the best performing accounts in their database were ones where the account holders had either forgotten they had the account or were deceased. The point isn't morbid. The point is that the absence of smart active management consistently outperformed its presence. Inactivity beat activity. Forgetting beat monitoring. That finding should be deeply uncomfortable for anyone who has spent significant energy trying to optimize their portfolio. Now, none of this means you shouldn't learn about investing. Knowledge is not the enemy. The enemy is the specific cognitive pattern of believing that more knowledge, more analysis, and more active management will produce proportionally better outcomes in a system that doesn't reward that linearly. Knowing that index funds outperform most active strategies is useful knowledge. Spending 3 hours a day analyzing individual stocks to try to beat the market is where intelligence becomes a liability. The question isn't how much you know. It's whether what you know is actually changing your outcomes or just changing how confident you feel. So what does this actually look like in practice for someone who recognizes themselves in this? The first step is genuinely internalizing, not just intellectually accepting, but actually feeling, that your investment process is not the primary driver of your long-term financial outcome. Your savings rate is, your asset allocation is, your time in the market is. The specific securities you pick and the timing of your trades matter far less than any of those three things. That reframe is uncomfortable for analytical people. It feels like surrendering. It's actually the most sophisticated conclusion the research supports. The second is building a personal investment policy statement before you make any investment decisions, not after. A policy statement is a document you write when you're calm, when markets aren't moving, when your analytical mind isn't being activated by current data. That specifies exactly what you will hold, what percentage, and under what very specific conditions you will rebalance or change anything. It functions as a rule rather than a decision. Because every time you make a decision in the moment, every time you respond to a data point or a market move or a compelling thesis, you're inviting the exact pattern of smart overthinking that consistently underperforms the rule-following alternative. The policy statement is the most useful thing an intelligent investor can produce because it protects you from yourself. The third is finding a different outlet for the analytical drive. If you enjoy financial analysis, if reading about companies and markets genuinely interests you, do it. Understand it. Engage with it. Just allocate a small defined percentage of your portfolio as your active sandbox and leave the core alone. Give the analytical part of you something to work on that isn't the bulk of your financial future. That way the drive gets an outlet and your long-term wealth doesn't pay the cost of feeding it. Here's the final thing I want to leave you with. The smartest investors in the world are not the ones who have found the cleverest system. They're the ones who have understood exactly where their intelligence helps and exactly where it hurts, and built accordingly. That self-knowledge is genuinely hard to develop because it requires you to identify the specific contexts in which your greatest strength becomes a liability. That's a cognitive task that most people, smart or otherwise, find deeply uncomfortable. But if you can sit with that discomfort, if you can look at a market that wants you to analyze and intervene and see it clearly for what it is, you will make better decisions with your money than the majority of people who are working far harder at it. Not because you've outsmarted the market, because you've outsmarted the version of you that was trying to. If this landed differently than the usual investing content, subscribe. Every week, we dig into the psychology behind why we make the financial decisions we do and what actually works. And drop a comment. Have you ever held a position longer than you should have because you were convinced your analysis was right? I'd genuinely like to hear it.